Credit investors have by and large had a solid run in the past 18 months. Per our calculations, investment grade and high yield credit generated positive returns through 2023 and 2024 year to date, with Asia credit performing the best against its US and European counterparts. It wasn't just investors that had it good, with higher for longer interest rates driving income and total returns. Issuers as well found a somewhat conducive environment for primary issuance with historically tight credit spreads. The Bloomberg Asia Dollar IG option adjusted spread reached a new all-time low of 76 basis points in late May, while the high yield option adjusted spread reached 467 basis points in late July, its lowest amount since July of 2020, during pandemic-era induced spread tightening from policy responses to normalize credit markets. The start of August, however, saw credit markets wobble. Asia dollar, excluding Japan and Australia, primary market issuance slowed ahead of the July FOMC meeting, while credit spreads widened. At the same time, various Asian equity markets opened the first full week of August in the red, with percentage falls at historical highs. The sudden correction in credit markets followed a confluence of factors, including soft US jobs data released at the start of August that reignited fears of a US recession and market concerns of a potential emergency rate cut. Additionally, the continued strength of the Japanese yen was seen to weigh on earnings growth for Japanese banks and exporters, as well as affecting pricing of financial assets outside of Japan. Escalating tensions in the Middle East also added to a flight to safety. These temporal influences, however, may not have been the only factors at play. Facing rich asset valuations and somewhat benign market volatility in June, we took the time to look at the external risk as disclosed in various financial stability reports published globally in the first half of 2024 and late 2023 to answer the uncomfortable question at the time of what could go wrong when things seem to be going just a bit too right. While higher for longer interest rates have been seemingly good for credit investors and issuers, it has also put pressure on corporate and household balance sheets. Liquidity is generally declining, and so are buffers to managing unanticipated shocks to incomes and financing costs. The problem is not yet widespread, with adequate cash buffers built through the pandemic to offset the rising credit impacts from higher funding costs and lower economic growth to date, and there have been certain policy measures to restrict over-leveraging. However, pressure is building for highly leveraged corporates and vulnerable households, especially those with refinancing coming due. The Hong Kong Monetary Authority's half-yearly Monetary and Financial Stability Report from March of 2024 highlighted signs of cash buffer depletion and expectations that more corporates in Asia could face repayment difficulties if operating conditions remain weak while interest rates remain high. International Monetary Fund's April 2024 Global Financial Stability Report also highlighted that erosion of cash liquidity buffers for firms in advanced economies and emerging markets over 2023 as corporate earnings appear to be losing momentum. Per the IMF's report, around 1/3 of small firms in advanced economies had a cash to interest expense ratio below 1 as at the end of the third quarter of 2023, and that number rose to more than half in emerging markets. At the same time, a large amount of corporate debt is maturing globally in the coming year at higher financing costs. Some of this, however, could be refinanced by private credit as opposed to commercial banks and public debt markets, and refinancing activities have generally picked up as investors and issuers take advantage of current market conditions. As debt servicing ability declines, credit demand usually falls and operating conditions soften. This will impact profitability and liquidity risks and add to rising deposit and wholesale funding costs for financial institutions. And this may indirectly lead to higher for longer funding costs for the economy and a subsequent reinforcement of softer operating conditions. The impact may not be so much a concern for larger, domestic, systemically important financial institutions, but more important for non-bank financial institutions, or NBFIs, whose participation in financial markets has grown in recent years and who have opaque and higher risk exposures than larger, domestic, systemically important financial institutions. The U.S. Federal Reserve's April 2024 Financial Stability Report highlighted how tighter financing conditions could amplify loan losses, leading to a further tightening in financing conditions, creating a downward spiral in confidence. Similarly, the IMF drew a connection between the high average correlation and multi-year low volatility across equities, bonds, credit, and commodity indices in both advanced economies and emerging markets, and the high susceptibility of investor sentiment to abrupt changes in data releases. This could prompt a sharp tightening in financial conditions. Existing weaker asset classes such as commercial real estate would be most exposed, especially where refinancing is imminent. But despite the declining debt servicing ability and potentially tighter financing conditions, there is consistent recognition by regulators that recession risks and a hard landing possibility have declined, with Federal Reserve Jerome Powell recently confirming a policy pivot by stating at Jackson Hole that the time has come for policy to adjust. The belief in a soft landing is likely only stronger, with easing monetary policy reducing pressure on debt serviceability. A major international rating agency recently published a report highlighting the expectations for the Asia-Pacific high-yield non-financial companies' trailing 12-month default rate to fall in 2024 compared to the end of 2023. This expectation factors in a less severe global slowdown, a likely decline in inflation, easing monetary policies, and improved liquidity conditions. That said, overall risks remain skewed to the downside due to the rise in geopolitical risks. These have increased the probability of unknown unknowns for global credit markets in our view. The negative impact of a severe adverse geopolitical event was highlighted by the Reserve Bank of Australia in its March 2024 Financial Stability Review as being amplified given the current expectations of a soft landing and the low risk premium and volatility across asset classes, with its interplay with financing conditions. An unanticipated outcome combined with fragile market functioning could lead to a disorderly adjustment in financial asset prices, leading to a hard landing, particularly in situations where there are shortcomings in leverage and liquidity mismatch management, including by NBFIs in key financial centers. These views are shared globally. The European Central Bank's May 2024 Financial Stability Review highlighted that the current benign pricing of risk in financial markets keeps asset prices vulnerable to shocks and raises underlying financial stability vulnerabilities. The US Federal Reserve's April 2024 Financial Stability Review identified stretched asset valuations as one of 4 financial system vulnerabilities, with any worsening of global geopolitical tensions leading to disruptions to energy and commodity markets and global value chains, boosting inflation, reducing economic activity, and heightening financial markets volatility and asset repricing. Finally, while a soft landing is the IMF's base case in their April 2024 Global Financial Stability Report, the IMF also identified the current environment as one with stretched valuations in various asset classes. Asset repricing could happen quickly from sudden shifts in policies or a flare-up of geopolitical tensions, sharply tightening financial conditions. The synchronized upward movement and low volatility in asset valuations, along with high susceptibility to abrupt changes in investor sentiments, is one of the IMF's financial fragilities along the last mile of disinflation. In summary, what various recent financial stability reports published globally have shown is that underlying sensitivity remains high and financial conditions can tighten rapidly. Weaker asset classes and highly leveraged credit issuers remain most vulnerable to this dynamic, particularly those with higher refinancing needs. Investors should continue to maintain vigilance in this period of temporal and persisting risks. As the UBS CEO mentioned during interviews around the release of the bank's second quarter results, investors should heed the recent global sell-off as a sign of fragility in the system.